Hello and welcome back. Today we're going to be taking a look at Intel Corp. We did examine AMD yesterday, a very interesting company, and now we're going to be taking a look at their arch rivals, Intel. And Intel has been hammered as well with the overall market. It's actually 30% down today from its last 1 year high, basically. And so we do want to see whether it's actually a potentially interesting opportunity here for us. Now, this company is, of course, a semiconductors company, that's the industry, and has a very low beta. If we take a look at the company profile here, you will see that the beta of the company is 0.55 here, has a lot of employees, a very old IPO, but yeah, this is a company that is pretty much a behemoth. It's a very, very old company, and it's doing fairly well. However, we do want to examine whether its current price actually is a good idea for us to to buy. It would be a good idea for us to add to a portfolio. Now, you will see here, if we take a look at the 3-year chart, that the company has been a little bit choppy, going up and down. That's typical for, of course, companies. And it's been trading at a range of 46 to 62. So we kind of want to get it at the lower range, which, guess what, we are at now. This is almost like the support level here. So from here, I could definitely see, at least technically, the stock going up. These kind of levels are important here because they provide psychological support to traders. They're like, okay, when the company reached these levels many times in the past, it went higher. And so this is why, even from a trading perspective, I would actually enter this company right now, even if I wouldn't hold for the long term. Now, we will discuss about the long term. We haven't talked about it yet, but I just wanted to mention that because I think it's interesting. And also, if you take a look at the marks, you will see the same thing with the resistance levels here when we're talking about the ceiling of the company. 64 over here, 68, 66. The reason why this happens is, again, a psychological level, because there tend to be backholders here. This is not magical lines. It's about psychology. People bought here, and then it went down, and then now they're trying to exit. And when are they going to exit? They're going to exit here at the first opportunity, and this is when the stock price goes down, because there is a lot of selling. People who were bulk holders here, now they can finally make their cash back. And the opposite way goes with actual support levels, as I examined earlier. People kept buying here, and so the price went higher. And so when our sellers have actually sold, maybe we're going to see a breakout. And this is what we're talking about, the technical patterns when we're talking about trading. But we're going to be mostly discussing the company for its fundamentals, of course. I just wanted to mention it because I'm pretty sure many of you are astute traders, and you may be interested in this. Now, the PE ratio of the company is sitting at about 10, 9.5, going down from the previous year, which is great to see. Price to free cash flow ratio a little bit more elevated, but still below what we want it to be. Now, it would be better if it would be a little bit less, but we have to compare it to the rest of the fundamentals of the financials of the company. A great thing to see, the outstanding shares going down from 4.7 bill to about 4.1 here. Hopefully, the company will keep buying some shares, and the free cash flow reserves from the last year can be used to actually repay back all the total liabilities in about 7.5 years from today, if they wanted to. It's a little bit more than I would like, but that's fine. 5-year revenue growth, the company is growing. Again, it's a behemoth. You can't expect it to grow massively every year. That's not going to happen. Net income growth is kind of steady. It went much higher in 2017 over here. The 5-year free cash flow growth is a little bit down, as you'll see. Now, this can be a little bit concerning because that's a steep decline from 2020, but there is a reason for that, and we're going to examine it when we take a look at the financial statements, which we're going to do right after. The 5-year total equity growth also keeps increasing, very nice, and the company, remember, is not issuing shares for the most part. It's mainly buying shares. So this is coming from net income. It's coming from actual money that the company is making. So the debt to equity ratio and the current ratio are both great values here, less than 1, more than 1 here. This is vice versa pretty much, and you can get an explanation here. This is better to be less than 1, while this is better to be more than 1.2 or 1. It's they are a little bit opposite to each other. So the return on equity, 22%, that's pretty good, almost 23, pretty nice. And a dividend yield of 3% that gets increased because the company's stock price has been going down, of course. So the effective yield gets increased. And so the dividend payout ratio is at 29%, which is very, very healthy. No troubles for the company paying its dividends, I wouldn't think. Let's take a look at the financial statements now. I want to see what's going on with the cash flow for the most part, but also how the company's revenues are increasing here, what's going on with the net income, for example. Now you will see that, yeah, this is about maybe 5% on average or so a year. We're going to examine that with our stock evaluation tool actually in detail. But the net income here also keeps increasing, of course. And again, another great thing to see about the company that keeps increasing its bottom line. Although the massive increase happened in 2017, these past few years have been much steadier, if not a little bit of a decline here. The balance sheet, though, and you should expect a little bit of a decline. No company will be growing its revenues and net income every year. Otherwise, they would surpass the economy. That's not going to happen. So there will be bad years and bad quarters, or average years and average quarters. What we do care about is the company increasing its cash reserves, increasing its balance sheet, basically making it better, and keep producing money, pretty much, is what we care about when we're buying these investments. Growth is great. I love growth. But sometimes, you can be a little bit boring and buy the companies that keep producing a steady stream of income. Why not? These tend to be very cool companies and can make you a lot of money. You will see here that the total assets are, of course, massively more than the total liabilities, and this actually means that we're going to be having quite some equity here, which is near 100 billion. That's nothing to sneeze at. That's a lot. Cash flow. Now, that's the important one that I wanted to examine here, because remember, the free cash flow has gone down tremendously here from 21 billion to almost 9.6. There is a reason for this. The reason is capital expenditures, because remember, how is cash flow derived? So cash flow is actually net cash provided by operating activities minus capital expenditures. So it's this number minus this number. And this is why we're getting 9.6 billion here. So if capital expenditures increase, or if net cash provided by operating activities decreases, then we're going to be having less cash flow, free cash flow. But as you'll see here, the net income and basically the net cash provided by operating activities is a little bit less, but it's not that much less that it would actually make sense for this decline. And the reason for this is mainly because of capital expenditures. You will see here that the company has been having a significant amount of more capital expenditures here, and this is why you're looking at a number of free cash flow that's much less. And you will see here that the company is also purchasing quite some investments as well, which is nice to see. I like to see when companies do that and also support their operations with their own capital expenditures. And now I also pulled up an article because I was curious to see what kind of capital expenditures were going on here. And you will see that Gelsinger, I'm not sure what his name is. He said on a conference call for investors last month that it plans to invest 25 to 28 billion in 2022 to ramp up its production capacity, upgrade equipment, and erect more advanced chip fabs. So as you'll see here, this is basically investing within the company, for the company. That's great to see. I'm all for that. So no big deal about the free cash flow going down here because it's projected and it's expected. So the rest of the things here, the free cash flow, as we saw, is getting a little bit lower. That's normal based on what we have seen. But the net cash provided by operating activities also in the negative here. A little bit of debt the company got here, but also paying some dividends. This is normal, very normal, and companies do take debt. Debt can be used for leveraging, and it's a great tool, especially when you are producing free cash flow, of course, and you can support it. Now let's take a look at the stock evaluation tool, because the company is doing great in terms of financials, but is it cheap enough for us to buy? Let's take a look. You'll see the revenue growth here, and we have our handy averages. Remember I told you it's about 5? Yeah, I was kind of close to that. It's 6% is what the company is making on average in the past 5 years. So we're going to be using 3, 4, and let's go 5. We're going to be very actually conservative here. We're going to be using even less because it could go down in terms of its revenue growth. So the net income margin, look at these numbers. They are very close to each other, which I love to see because it can be predictable. The company is doing the same every year. Love it. So let's go 22, 24, 26 here. I think that makes a lot of sense. Free cash flow margin, again, very predictable. There will be some years where the free cash flow is a little bit different, and that's because, remember, capital expenditures is actually what skews this down, to be expected, of course. But typically it's like 80 to 100, 107, and some 70 here. But I'm gonna go 80, 90, and 100. I think makes a lot of sense. An annual return of 13% is what I wanna be making from this company. and when I hit calculate, I'm getting everything green here, which is what I absolutely love to see. You know me, I love buying cheap. And so with the current price of 45.67, the low, which is the max price to pay for this kind of projections, which I think are very, very possible to happen, is actually $51. It's significantly more actually, because remember, this is 45, it's not like 450. And so $6-7 difference, $6-7 difference is like 15%. So that's a pretty big difference actually. Medium is 66 and high is to 83. So definitely a great looking company based on the financials. And it's actually a company that, as I mentioned in the beginning of the video, I am looking to add to my portfolio right now, because it looks like some potential here, and some numbers that it's almost impossible to pass, at least for me. So thank you for watching the video. I hope you enjoyed and you like this analysis. Tell me know what you think about Intel. Do you own it? Do you think about buying it? Let me know. Leave a comment below. And remember to like and subscribe. And I'll see you in the very next video. Take a look at this one that I made as well about AMD if you want to compare these two. And thanks for watching again. Bye bye.